All right, now we're now live, and yeah, ladies and gentlemen, welcome to the Superlative Podcast. I'm Edward Bushi. One guest, no edits, no post production, just a wrap, live conversation about what it takes to reach higher levels and what comes next. So let's get into it. Andrew Romans has watched venture capital get turned upside down. OpenAI just raised more in a single private placement than the four largest IPOs in history combined. And Andrew says most VCs still don't understand what that means for the next 10 years. So, Andrew, a big hello and welcome to the Superlative Podcast. Thank you for being on the stage. Would love to get a small intro about you and what you're doing at 7BC before we start the conversation.
Sure. Hi, Edward. Thanks for having me. Real fast, I was an entrepreneur in the kind of early internet technology days, telecom days, and I went through a series of startups raising over $300 million of venture capital funding. So, in the late 90s, early 2000s, I was meeting kind of every active VC that was in Sand Hill Road, Silicon Valley type stuff. I then had a series of M&A, IPO successful exits, and some big bad failures. So I've seen how it is when it's going well and how it is when you got to work even harder. And then I started in venture capital myself. So I've been in the VC game for about 20 years, going on the investing side. So that's kind of quick background on us or
Gotcha,
on
gotcha.
me.
Yeah, so yeah, thanks for that. So I know like one of the things that I learned from our onboarding call was how capital markets change. But before we get into that, right? I want to know like what was life like as an entrepreneur when you began? What was the VC game like then? And yeah, could you paint a picture for us to set the context?
Yeah, I would say like the internet was still pretty new. A lot of people were still not even on email, and there was no list of angel investors on the internet to go to. I literally went to National Venture Capital Association, like nvca.org, and they listed from A to Z, and just like went through each one, researching everybody's bio and like setting it. These days, the world is so different. You have not just angel investors, but you have lots of accelerator programs that'll take in a startup that is not even incorporated yet and hasn't even raised a dollar or done anything. And they will fund you and get a whole community. So you might be from the mountains of Nepal and then show up in San Francisco, New York, or Tulsa, Oklahoma, or wherever you landed and get a huge amount of support. And then I like to give credit to Ron Conway for forming SV Angel, Silicon Valley Angel, where he raised money and he was investing in like 3 companies a week that were pre-revenue. And he's maintained, in fact, he upped that pace and writing bigger checks. And then a lot of people saw him with, this highly diversified strategy of just investing in anything that looked credible. And so now you've got a ton of these pre-seed VCs that will throw money at a nice team with a good idea relatively early. So there was none of that. Like I had to call my ex girlfriend's father. You know what I mean? Like it was very hard finding anybody. You meet a rich person, they're like, "Hey, I'm rich, but I don't do this."
Yeah. It
You
must have been a
know?
slog. It must have been a slog to like to close around too. Like, and it was a closed circle of people that you were working with.
Yeah, but at the same time, it was different. I mean, I'm nostalgic thinking about it. That it was the .com days. So the expectation from a lot of these investors is that I'm going to write a check into your company, and 6 months later, you're going to IPO and go public.
Hmm.
And in fact, in our conversation on the onboarding, I was saying that some of the evolution is that in the late '90s, when with the .com boom before the .com meltdown, you could go public and rush the public for venture financing, and so as much as it was a hard slug, kind of the younger and dumber you were, and I was both young and dumb, so like I was attracting all this money actually, and you
That's
got on the
kind of
cover.
intuitive.
You get on the cover of Wired magazine or something, and all of a sudden the phone is ringing and money is pouring in. So that doesn't seem to happen so much these days. So it's a very different world. But I'm excited to talk about that evolution of the capital markets if you want to get into that.
Yeah, totally, totally. So, Just one question about like before moving on to the next part. Like, uh, was there anything about like your life as a founder that got you like set up and got you like you're seeing the other side that made you want to be a VC? Like, how do you describe that transition?
I think I'm guilty of the same consistent pattern reaction that many entrepreneurs have. You
Hmm.
walk into the VC's, boardroom, conference room, and you're like, all right, well, these guys look like they've got money. And then you pitch your idea as like a relatively poor person, someone who needs money badly. And there's a little bit of a dynamic of like, he's got the money, I don't have the money. I'd rather be that guy in this whole negotiation. Like,
Hmm.
I'd rather be, on the French and the American British side negotiating with the Kaiser at the end of World War One than be the Kaiser,
Hmm.
So a lot of entrepreneurs think the grass is greener on the other side and they should go over there. And I did. And I encourage founders to not be, oh, we're operator turned VC investor. Just stay over there as a founder.
Hmm.
You've got literally less competition and life will be much easier for you. So I encourage founders to continue to be founders and stop all coming over to the VC side, because there seems to be like a massive exodus of the founder makes a little bit of money selling some of his shares on the secondary market in the B or C round, meaning like VCs fund the company for 25 million and they buy another 5 million from the founder. And now the founder's like, all right, that's it. This is my path to becoming a VC. And I'm like, well, when you become a VC, you may find that you've got more competition here than you did over there.
Yeah.
And there was all this money ready to throw at you. And nobody wants to invest in your VC fund. We just don't care. Like in the LP community.
Gotcha. So, like, one of the key things that stuck with me, we are now the industry right now. Capital formation is a state, right, where companies can have and command huge valuations before IPO. You gave OpenAI as an example, right? But before that, could you describe like what the hell changed between like when you were a founder in the 90s to lead up to this point? It seemed like there was a Venn diagram of events, right,
Yeah.
that took place.
Yeah. And by the way, I didn't answer your question very well. The short answer to that question is yes. Having been a founder who's experienced receiving financial venture capital and even corporate venture capital, I raised like $27 million from Lucent for one of my companies. I feel like I'm empowered to perform much better as a VC than had I not had that experience. When a lot of VCs that I meet, especially the well-established one, have never been a founder, or they were for like 5 minutes and like they were never an operator. They were like 6 months. They worked at a startup and then it like IPO'd, and that's their entirety of their experience. And now they've been a VC for 30 years. It's kind of like if you walk into a busy bar in New York City and you see some guy open his wallet and start shaking like a $20 bill, like that is going to get the waiter to say, everybody get out of the way. I'm parting the seats for this a-hole that I'm going to serve first. If he had ever been a bartender, he would know the last thing you should do is say, I have fiat currency to pay for the drink like no one else does. You know what I mean? So I think that use that as an analog for the metaphor of if you've been an operator and you've been through all the ups and downs and you know what it's like to like, how do I tell my founders we have no money to meet payroll for more than 6 weeks, and yet I have to look strong to the next VC to keep funding us? I've been in their shoes, and I think it is helpful. But I don't know. So the next question, I'll try to give a tight answer on how have the capital markets changed. Is that what you were?
Yes. And first off, also appreciate like that insight. Being an operator also helps. Before being a VC, being an operator really helps speak to a founder at their level, and that gives you more insight. But yeah, my question was, OpenAI was an example of like ginormous valuations, but it didn't just suddenly happen, right? So I wanted to ask, like, how did you get here?
Yeah, well, I think that if you look at where AI is with everybody from the big, Anthropic, OpenAI, shattering what's normal. Like, OpenAI raised more capital in their recent private placement of 122 billion, is more cash than the totality of funds raised in the initial public offering issuance of the largest IPOs in human history. So if you take how much money was raised in the 4 biggest IPOs in all of human history, it's less than the amount of money that investors wired maybe a bad example because some of that is in-kind investing with compute, but it's less than how much they raise in a private placement. So that's very different. Another difference is that we now have, I used to make a big deal about being operator turned VC and how, you shouldn't be allowed to drink at a bar if you've never been a bartender kind of thing. That's sort of like no longer a differentiator. There's like an ocean of operators turned VC, which makes for a whole better working ecosystem, I think, than just all these guys that raise money that were bankers that have no idea, or consultants that have no idea what it's like to be us. I'd say that the fast thing was that we had an old boys club before there was even websites and email, that if you went to Stanford, you could get a meeting with a VC, and it's kind of a Stanford insider boys club, really. And then that changed. And then you had the .com era, where young and dumb people like myself were able to raise lots of money and often go public very fast and get liquid. The amount of time it would take for the VC and their limited partner investors to get their money out. So you put money in a VC fund, the VC wires check to the startup, and if they IPO 6 months later or a year later, even 2 years later, there's back then you actually had an 18-month lockup, and that's changed to a 6-month lockup. So the IPO happens, founders can't sell for 18 months, which was a problem for me with one of my IPOs. Whereas now you just got to wait 6 months, and then you can start selling shares on the public stock exchange and then get cash in your pocket instead of these shares that don't pay for tuitions or diapers or a lift ticket, right, in the real world. Then the .com crash happened, and the rules for going public with like Goldman Sachs, Morgan Stanley, JP Morgan changed. That they told me the new rules are 6 consecutive quarters of profitability and a minimum top line revenue of 225 million. And I was like, oh, so I can't just change my name and add .com to the end of it and immediately go public?
Yeah, they're like, yeah, something on your book.
They're like, those days are over. And so basically the window for IPOs was completely shut. And then even for M&A, the valuation, like the multiple that the buyer would apply to your revenue. So if you've got, $100 million of revenue, instead of selling that company for 10x that, for like $1 billion, they were like offering $100 million to buy your company. And so people are like, all right, I'm not going to sell at such a low, crappy multiple in this .com nuclear winter of the early 2001, 2, 3 kind of period. By 2006, we started to get out of Armageddon nuclear winter there in Silicon Valley. New York was coming back to life. I jokingly said, you know what B2B and B2C stand for after the .com crash? It means back to banking for you and back to consulting for you. Tourists out. Real entrepreneurs only, right?
Yeah.
As opposed to business to business, business to consumer, or B2B2C, crap. Then we got into a world where the time delay between the VC investing and seeing an M&A exit, which was pretty much the only positive outcome on a venture-backed company, with the IPO window completely shut, went from like 1, 2, 3 years to just every year that we got older, it was another year of waiting. And there was always some kind of famine, plague, crash of the stock market, or some reason why we're not selling our companies.
The recession happened also in 2007 too, right? Like
that's right. I mean, 2007, August 2007 was a credit crunch, and then the rest of the market caught up a year later by September 2008. Bail out people that are richer than the rest of us. Then we kind of woke up and said, we're in a world of stay private longer, or God damn it, stay private forever. Like when the hell can we IPO or M&A this thing? Mergers and acquisition. I want to sell the company. And at some point, you have to provide liquidity back to these high net worth individuals, these single family offices, these endowments, these pension funds, these insurance companies, these sovereign wealth funds, whoever the hell put money into these VC funds can't just keep wiring us money, and we wire the money to the startup and we never wire the money back. So what is evolved in a stay private longer or stay private forever type of world was the VC funds started raising bigger funds. So like New Enterprise Associates, NEA, Chuck Newell, Dick Kramlich, they went from being a $350 million fund to a $1 billion fund. And Dick told me, sadly, he's passed away, how did you raise a $1 billion fund? And the LPs, investors that have been backing him, said, how the hell are you going to invest in startups and deliver back $1 billion? And he goes, easy. If I own 25% of 4 unicorns, so $1 billion exit, voila, there's your $250 million back. And to make it easy, I'll own more than 25%, and I'll invest in like 30, 40 companies in one fund. And if I hit 4 or 5 that are hitting $1 billion exit, we're there. Now, that's the problem with this, is that when his fund got so big, the startups didn't want to raise $50 million. They don't need $50 million or to raise 75 or 100 million.
Yeah.
And so when it was being offered by these supersized VC funds, and this is the real evolution of this, the private to public markets, is that why should I go public if I can raise 100 million from SoftBank and NEA and Redpoint and Lightspeed, these big VCs that are not really VCs. This is like, public stuff, really, or hedge fund stuff. But if I can raise 100 million, you give me 100 million, and I will spend money on advertisements and increase my CAC spending. I will hire more engineers to, increase the surface area of value and, automate more stuff and put more AI into things and increase my average contract value with existing logos. I'll hire more salespeople and get new logos, and I will basically double revenue in a year. And if I'm doubling revenue in a year, why should I sell more than 10% of the company while it's this cheap? Because a year from now, I will have doubled. I'll be handing out $100 bills at the shopping mall for $50 of revenue if I have to. So we went through this period where NEA is like, all right, so you're only selling 10%. You're going to issue 10% stock. I promised my LPs in France that I'm going to own 25%. What happens if you sell the company and I only own 10%? Well, guess what? He doesn't get the whole 10% because the other VCs want to put money into that because they have a pro rata equity right to maintain their ownership percentage. So the early guys like me, I can pool money in an SPV and be in that round too. And so NEA only gets and I should stop picking on NEA. A big VC is only getting 5% ownership or 7%. Or if they're really sharp elbow Sequoia, they get 10%. In order to get to 25, they crossed over from primaries where they're funding the company to buying secondaries. So now we had liquidity without an IPO, without an M&A. Now
just by selling to other investors, who want to get in the game before an IPO. That's what it sounds like. If I were to,
but they just want to own more of it, and
okay.
I think IPO is still far in between. The percentage of companies that raise money from credible, well-known VCs like us that get to an IPO is a very small percentage even today. Everyone's talking about Anthropic and OpenAI, but how many companies actually IPO? Not that many. And when Anthropic a year from now has a $5.8 to $25 trillion valuation, if antitrust doesn't slow them down, they're going to be buying companies, and you're going to sell and get yourself some Anthropic stock, not in cash, not IPO yourself. But the bottom line is, you're right. The short sentence is that you used to be able to get your money back with a quick IPO, quick M&A. We entered a period of nuclear winter where this wasn't happening. The VCs were raising larger funds to be able to continue to fund companies that never go public, that never get sold. And then they were unsatisfied with the percentage ownership they're getting in the companies. So ironically, an early stage VC like 7BC Venture Capital, we invest earlier than those big funds who have been pushed out of the VC game because they like that 2% management fee on a $6-8 billion fund.
That's their model.
They're getting rich with zero risk. So although we're further in time from the M&A or IPO exit, we can pay money back to our investors, our LPs that gave us the cash to invest in the startup faster than they can. Because I can sell 10%, 20% and say, okay, Dick, you wanted to own 25% of the company. You only have 6 or 5 or 7 or max 10. I own 20% of the company. How about I sell you 2% more? So I'll go from owning 10 to 18.
Yep.
I just sold some shares and I paid the whole fund back.
Yeah.
Or I do that with 3 or 4.
At a higher price. Yeah.
So I buy low, sell high, and And it may be that that IPO never happens, and even they could foie gras, overfeed, and overfund that startup, and they start hiring social media person in goddamn Buenos Aires and stupid spending of the money, and the company could go to zero, or at least I could get washed out. You know,
Yeah. That's
so
that's so interesting
yeah.
that you use the word the foie gras startup. I've never heard that before, and maybe that's like very apt, right? So one thing about the onboarding call that we had earlier, you used Lyft as an example, right? It sounded you said Lyft started with 350 million and it ended at 650 million when Carl Icahn and Fidelity came in, right? Was that the turning point for you that
Well,
you realized
for me, I
how it works?
remember, like I've met Peter Thiel a couple of times from Founders Fund, and he was the guy behind Lyft,
Hmm.
and then Benchmark was kind of behind Travis at Uber. And I remember seeing the company was going to raise 350 million, and at the time I was like, dude, that's more money than you get in an initial public offering. Like that's a big IPO. Like, and when one of the reasons you IPO is to actually raise money at a higher valuation than you'd be getting from VCs who maybe don't even have that kind of money. And so I saw 350 million, man, that's big. And then we saw like General Motors got in because they wanted to lease cars to the people who have no money that can't even afford a car. So like problem solved. Here's a General Motors car on lease from the company. And then they put money in to like get a monopoly on the leasing program. And then Fidelity and Carl Icahn invested. And I was like, whoa, whoa, whoa. These are people that invest in an IPO and after an IPO, not before the IPO. So the demarc between privately held and publicly traded has just blurred completely. And this is a probably permanent change to the capital markets. So that was a little bit of an eye opener for me. And I think they went out to raise 350 and they came back with 650 because there was so much investor appetite. Those numbers could be wrong, but you could look it up and it's something like that.
Yeah. I wanna follow up though because like if a big fund were to come in and get in on a round before the IPO, you're saying yeah like I invest in a unicorn, right? But that's like an assumption, right? Like what from their point of view, how are they de-risking the 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 purchase of these shares at higher prices? Like is it only
Well,
the 2% fee that or sorry the management fee that they're after is that all they care about?
are you asking about like the NEAs of the world that used to be like early stage VC that now raise so much money they're more into some kind of mezzanine finance? You mean,
Uh, uh
or do you mean the crossover? So
I'm
crossover
talking
is
about
a
the
term.
crossover. Yeah, the crossover. The
Okay, so,
big investors coming in and not being in this space before, usually being risk averse. Now they're like, I want to buy Lyft or buy Anthropic and stuff like that.
well, I think that the world used to be this kind of small boys club of Stanford people in Menlo Park that were investing in companies, and there was no email, there's no website, there's no internet, right? And it was very hard to get into that. And then they would go public, and they would bring in Goldman Sachs, J.P. Morgan, Morgan Stanley, and IPO these companies. And then there was like the Four Horsemen, but and you got your Boiler Room Long Island IPOs and stuff. But in general, it was like VC is over here. We're gonna hand the baton from the private market to the public market, and it's gonna go out. And then you had all these Fidelities and like Bain Capital that were in the business of having access to the IPO. And if you have 40 million plus with your wealth manager at Goldman Sachs, you actually get an allocation to invest in the Yahoo IPO. I remember trying to invest in the IPO of Yahoo as a kid, and I quickly was sort of like, everyone's like laughing, like, dude, you're nobody. You have no access to that IPO. The world is grifted and screwed, and American politicians have all been bribed, and all these wealth managers get kickbacks for what their CIO, chief investment officer, has said is thumbs up. So they give bad investments to their clients, and the world is a really messed up place. And unless you have 40 million plus parked with Goldman, you will not have access to the IPO. But the good news is that they design these IPOs to be priced to get a 40% bump on day one. So if you are with Goldman, who leads the IPO, they get you into the actual initial public offering on the roadshow, and you get a 40% bump on day one, and I guess you can even sell. Like, so it's a crazy, crazy world.
Yeah.
Now, these companies don't go public. They stay private for a long time. Note that Carl Icahn and Fidelity are investing in private companies, I don't really call this venture capital, but like the press would, and like all the messed up numbers, commingle my numbers of investing in early stage with that stuff. But so if you want to get that first day bump, you got to cross over from the public markets into private markets and invest in that company while it's private. And it creates more opportunities for us to sell early. Now, here's the thing. If you are a VC that used to have a 350 million fund and now you have a 6.8 billion fund, you raise that every 2 years. So you got to deploy 6.8 billion in 24 months, max 36 months.
You have to do it.
So your job is like, dude, I got to move this money. And so they call me and say, Andrew, what do you got where I can find a safe home for 50 million? And then 6 to 18 months later, I'll pound another 75 or 150 in. I got to move my money. I am highly motivated to move this money. And I'm like, all right, well, let's have a working lunch and go through everything that we have, it is what happens there. But the problem is those guys used to have kind of a monopoly on my deal flow for these pre-IPO, pre-M&A, late stage growth investments. But then hedge fund people who literally get paid for owning Microsoft stock and Amazon stock and doing nothing. Like in my view.
Oh, not even selling after the IPO, just holding it.
Well, I deal with founders ready to commit suicide and quit. And I'm talking him off the ledge. He's on divorce number 5. And I'm like, don't kill yourself. These guys just raise billions and invest in Microsoft and sit on it and do nothing. Those guys that have 80 billion, 150 billion of assets under management, AUM, are crossing over and saying, I got to get in on this Anthropic thing now. And so they cross into privates and they say, what is the valuation? And we're like, it's 350 billion. Make it 700 billion because I want to move a lot of money into this.
Oh, okay.
And for them, they're like, I don't care if I pay more money than the company could IPO for today, because when it does IPO, I will put even more money into the initial public offering. For the last 80 years, I'm on the roadshow where the Learjet stops when they're building out the book of the IPO, and I invest after the IPO. I'm a hedge fund who gets paid for doing nothing. I'm a compensation plan masquerading as an asset class. So for them, they're like, look, what is Anthropic at now? 35, 40 billion of annual recurring revenue, ARR.
Yeah.
If I invest at 25x that, within a year, they will have 10x the revenue probably. And at the worst, it'll 2x. So if it 2x's or 4x's, my multiple is down. I'll put more money in later. I can even hold the stock for 5 years after the IPO and continue to pay myself risk-free gazillions. So they're ready to pay. If this is the valuation it would IPO at today, these guys cross over into privates and are willing to pay at a higher price, and they'll have to wait for it to grow into that valuation. And now there's a delta that they bought low and can sell high. But they're patient. Whereas if you're that NEA VC, you kind of have a 10-year term VC. You're saying this is growth, so we should be able to be paying out much faster. You got to overpay big time to stay in that game. So it's a very interesting change to the capital markets.
So this is really, really interesting because you mentioned Anthropic. You seem to have an eye for that, because that might even eclipse what OpenAI has accomplished so far. Do you want to talk about that a little bit?
Yeah. So first of all, I think that what you're going to see is all these big companies are just going to keep leapfrogging each other.
Yeah.
And it'll be shocking to see what they can do and leapfrog each other. So right now, everyone's figuring out, I don't like Sam Altman, and OpenAI can't be trusted with my data. They just raised 122 billion. That's more than all of the big 4 IPOs combined. I think Sam can come up with a product that is an appliance that he could stick in your walled garden of a Fortune 100, 1000 and say, I can't even touch your data. And I've got a dedicated team of sales engineers and biz dev people to say, how are you using AI? And we're going to take a bite out of the market share of Anthropic. And you're going to see OpenAI completely leapfrog at what they're going to do with that 122 billion. And then you see Anthropic leapfrog them. And you see Perplexity come out, and you'll see different, maybe Meta will come out. Maybe Apple will figure out how to do it on a distributed iPhone computing system. So, but if you just do some numbers. So, OpenAI or Anthropic added grew their revenue from 19 billion, and they added 6 billion of new ARR revenue in the month of February, which is the shortest 28-day month of the year. They grew by 32% revenue, not year over year, in the shortest month. So I kind of think it's safe to think they're minimum doing the Silicon Valley 4x revenue growth a year. So if you say they are at, let's say conservatively, 35 billion, okay? If they're at 35 billion now, and they manage to 2x revenue, so they're at 70 billion in a year from now. We all know that is completely childish assumption. They're going to have well more than 70 billion in revenue a year from now. But if you look at a comp of Palantir, what is the multiple of revenue that the stock market is pricing the stock and the market capitalization of Palantir? It has ranged between like 80 and 110 over the last year, or at the peak, and it's like 60 to 85. If you take the low end multiple of what multiple of 70 billion revenue, which is already a ridiculously low number, what is 70 times 60? It's 4.2 trillion. So they should be worth a minimum of 4.2 trillion. And I would say, how many people in Africa under the age of 12 are familiar with Palantir? Probably not that many. You got to kind of be from Silicon Valley or New York to even know, or part of the military world, even know who Palantir really is, or fintech. Whereas like everyone, if you have not heard of Anthropic and Claude, after they IPO and become the largest company by market capitalization in the world, you will hear about them, and you will use it for free, and you will start paying for it a bit, and because you're getting much more out of that than some employee. So now let's say that they're 35 billion, easily 4x's. Now they're at 140 billion. And if you got the top end of the Palantir multiple on revenue to say what's the valuation of the company, we'll go 140 times 110. It's at 15.4 trillion. Okay? They're at 15.4 trillion. I think that, if they were to continue, they can't 10x revenue every year. But if they're at like, 40 billion now, and they grow that times 5x, so they're at 200, and they get a double multiple that Palantir, because everybody knows this thing and is using it, then they're getting a 220 multiple. They're at 44 trillion. So when you see people, investing in Anthropic at this 900 billion pre-money valuation, they are very West Coast, saying, I'm selling stock at a very low valuation so that it could be a walk in the park to see that thing really deliver and have a fully subscribed IPO and make everybody happy with a 40% bump, and then continue to hold the stock and watch it go up. And if they ever need money, they can sell some shares openly on the stock market. But they, so it's an interesting company. So this is like a once in a life thing. I mean, this is.
I get that part, right? Like that. How do you even say? Like Anthropic could like really break some records here. But then you're talking about how some players coming into the private markets also expect to make money when after the IPO. Do you think there's even more bumps after the IPO for something like Anthropic if it were to reach 40 trillion? That's already so high.
Well, so maybe a good way to answer your question, Edward, is what's going to happen with Anthropic? But that's like a Mona Lisa. There's only one kind of thing, or it's in a very small category. People were kind of, I think, childishly saying, oh, I think Anthropic is the enterprise one and ChatGPT, OpenAI, is the consumer one. No. They're both big enough to walk down and get them all and vertically, deliver products for everybody. So I think that if you forget Anthropic, and just imagine a company that has had strong momentum, growing revenue 4x year on year, has good unit economics, and everyone loves it. It's just a good old SaaS company, AI native, killing SaaS, eating SaaS, coming out of the valley, and it's on track to IPO. If they start behaving the way OpenAI and Anthropic have, you got all these guys like me that put together a special purpose vehicle and we market it to our institutional and accredited investors, and we're raising money and we're buying shares in the next primary, or we're actually buying shares right off the big VC, that was in it at like 400 million valuation, and now they want to sell at the 6, 7, 8 billion valuation or something. That we're managing to get anybody who wanted to get into this unicorn, decacorn, centacorn is getting access to owning shares in that company, maybe through an SPV, but we'll release the shares after they lock up. I mean, so it's true ownership. If the management gets on a Lear jet and bounces to all these cities on the initial public offering roadshow, and then they go visit a family office in Zurich, and I just got, I'm going to be in Zurich next month, and Geneva, and Monaco, and Frankfurt, and Munich, raising money and getting money into our VC funds and into SPVs for late stage stuff. They could be like, oh, no, we already met 7BC and we put in, $18 million. And I know we usually invest in the IPO, but we're already on the cap table. I'm curious to see how it performs. So it's kind of this is the evolution of the capital markets, that like, what is going to happen with some of these IPOs when everybody who would have been in the book, like they fly around in a Lear jet and they say, all right, they're just Goldman Sachs is nothing but a travel agent and bean counter that gets paid 7% for doing what an AI on Kayak can do. There's a big, okay, so you heard the CEO Travis pitching Uber. How much Uber do you want for the IPO? They're like, put me down for 25 million. They're like, okay, 25. Is there a max? Could be 50. So 25 to 50. And they're like, okay, so we have 25 in this column and could be 50 from that Swiss single family office or something.
Yep.
Then they go to then they fly to Geneva, then they take the train to Geneva, whatever. And then they build out the book. Well, what if all these people are all already on the cap tables because they've crossed into privates? There's guys like us who can get them in. Are they going to say, all right, I put in 18 with 7BC, which was supposedly the last round before the IPO. Maybe we invested in the primary, or we bought shares from someone that was in the A, B, C, D. We even know the seed guys. So if any seed guy gets it, we probably know those guys. So they want to sell to us so they can return the money and raise the next fund effortlessly. If they don't sell to us, they're saying, oh, look at how much we're worth on paper, but I haven't wired you any money back. It's harder for them to raise that fund. So if you wire money back to your LP investors and say, we're now raising fund 2, fund 3, fund 5, fund 7, and they say, I invested in your fund 1, your fund 2, and your fund 3. You give me like 50 grand back. I've already wired you 5 million. It'll be much better if they can sell a little Uber stock to us, return the whole fund, and say, hey, you want to re-up in my fund 3 or my fund 4? Way, way, way easier. So I don't know. I would think that for something like Anthropic, there's probably an insatiable demand and appetite for people that want to invest in it. So I don't think it's going to break the IPO circuit where no one is investing in the initial public offering roadshow because everyone was already in.
Yeah.
I think that, there's going to be some conservative pools of capital that have a charter that we only do liquid. We're the New York pension. We've invested in VCs. That's our private stuff. When we're doing allocations for directs, we only do, in the IPO where it's a contract, they're going public now. Like in under 4 months, we'll be liquid. Okay. So, but anyway, it is changing.
So it sounds like there'll always be players just by the nature of their mandate or their constitution to come in after the IPO. It sounds like there's still institutions who haven't crossed over to the public.
There's just a lot of people that are like that.
That's how you're painting it.
I remember I moved from Silicon Valley to Austin, Texas during COVID, and I'm like, all right, well maybe I should raise money here now that I'm a Texan and I'm local. And I remember going down to Houston and up to Dallas, and I had like business school friends that were making a lot of introductions, so a lot of lunches, a lot of meetings, and almost everyone's like, wait, I don't see the word redeem. how can I redeem and get out of this? I'm like, the only way you get your money back from a VC fund is when we IPO the company and we survive the lockup and we sell some shares on the public market, or it's M&A. We get stock in another company that is public, or it's cash and stock, complicated PE stuff, whatever. And we wire you that exit distribution from an M&A, or we sell shares on the secondary market to either our own SPV or some other buyer. So, we're selling at a higher price and we wire your money back. And he's like, so I'm helpless. I can't just call you up and say, I want to get my money out. I'm like, you cannot redeem in a VC or private equity fund unless it is listed on a stock exchange. And most of these guys were like, well, that's just not what we do. We don't do that. I need the safety of like, I keep my money in diamonds and I can run when there's a pogroms or whatever. They just don't have the patience to be locked up in an illiquid venture capital fund, So I think there's going to be always an abundance of people that, they got their pizza pie of how much do we have in publicly traded equities, and they're so big that Goldman will stop the jet at their office and pitch.
You're right about that. So that makes sense to me, right? So there's no shortage of money either in the private or public side. Right?
Well, I would say though it is interesting because like if you strip away the Mona Lisa one of a kind insanity of 10x, hockey stick, not hockey stick, rocket launch of revenue growth, where they're growing revenue by 32% in 28 days of February. I think it's possible that you might see some IPOs say, all right, we're going to go public and list the stock on a stock exchange, maybe even the Texas Stock Exchange or the NASDAQ. And this is not about a fundraising event. This is about just going public so your neighbor can be involved and everyone, owns a bit of SpaceX, whatever, I mean, SpaceX and Mona Lisa. So like they could always raise money. Yeah. But I think you might see if all the public IPO people and hedge fund people who love the word redeem, if they start crossing over and they've satiated their appetite for that thing, I think someone's going to have a tough IPO to raise money one day, but it won't be OpenAI and it won't be Anthropic.
So that's like we've actually been through a lot about your insights, and it's really like fascinating and really thought provoking. I've never seen it as a founder or rather I've seen the after effects of it. I've seen the high valuations, but I never really saw the mechanics. Like as a outsider. So I really like appreciate you sharing that insight. And I want to get into the craft that you do at 7BC, because you get in way earlier, right? And I think part of our onboarding call was you work with operators or founders. You have them be I'm being very, very rough with my language. You have them be the VCs, and that's how you get in early in those companies. Could you describe like that process? It sounds like it's also an edge of yours at the fund.
Yeah, I mean, for about 18 years, I ran a company called the Founders Club, where it used to be taboo for the founder to sell stock before the definitive liquidity event, IPO, M&A of the company. And the VCs, you say, hey, no way Edward is going to walk off with $5 million cash when I haven't gotten $1 out and I'm waiting for the M&A. And during those dark days of the ancient times of the early 2000s after the .com, I created the Founders Club, where if you had raised money from a top VC kind of off my Ivy League tier 1 list, you could apply to the Founders Club and you could transfer up to 10% of your stock into a limited partnership. And I would get like 25 other startups in that. And so now, instead of Edward only owning the Superlative podcast and you own like 30% of that, your founder owns 30 and the VCs own it, you go to owning 27% of that. We now own 3% of your thing. Other founders and angels come in. So we got more. And there's 25 companies. It's called a venture capital equity exchange fund. So whenever there was an exit, I pay 80% of that exit consideration to all the founders and then 20% to our management company. And I had investors. And we had 54 VCs rubber stamping who got in, including NEA. Okay. Like big VCs, would just rubber stamp. And they would tell their founders, this is a good idea for you. Let's get you diversified. so you can fight for the IPO and you don't sell to the first guy who comes along trying to buy this for 50 million. I need to return this thing at $1 billion for me to even return my fund. So but by doing that, like even when Elon Musk raised money for Solar City, I had a go-to-meeting call with him. He was too busy to come to my office or have me over, although he was right up the block in San Mateo there. But at any rate, so the bottom line there is we knew every founder that ever raised money in the Silicon Valley and half of New York and Seattle and other Austin and other, hot tech corridors. Eventually, a lot of those guys started selling shares in the secondary market or getting their own exit. And then they would cross over like me and become a VC. And so a lot of these VCs, I knew them when they were founders, or I knew them, when they were an associate. And now that, I knew Heyman when he was an associate at General Catalyst. He's now the CEO. He's like congratulating Donald Trump on his election, So I knew a lot of these big, multi-billion-dollar guys when they were little. And so it gives us an edge to be able to invest, to buy shares directly off of the VC on the late stage stuff. And it gives us an edge that if we fund a company, we introduce them to the next VC to fund them at the higher valuation. So we have a high graduation rate. If you get funded by us, you're not going to be short of warm introductions to the next VC. And we have 3 basic pillars to 7VC Venture Capital. We've got one, an early stage VC fund where we fund the startup, sometimes even pre-revenue. 2, we have a fund of funds where I saw every founder is becoming a VC now. I don't like it. Too much competition, but maybe rather than swim against the current of the Amazon, I should harness the universe and go with it.
Yeah.
Right. So I said, I know that most of these guys that are founder turned VC will never get the endowment pension fund, New York police pension. They'll never get it. There's some sick numbers that 90% of all the money in VC is going to 19 VC funds. And then I've recently been hearing numbers that need to be checked of actually 3 funds are getting more than 60%. And people are calling it consensus capital, that only 3 funds are getting more than half the money. So it's, imagine, you're single and you're hoping to meet your wife and you go into a bar.
Yeah.
And there's only 3 women in that bar. If they say no to you, now what are you going to die a virgin? Never have kids. So it's kind of a bad situation that there's so much concentration. So we see it as a huge opportunity to say, hey, none of those guys are going to ever fund you. You're just dead on arrival. You're never going to get it. Their bonus doesn't get any bigger or lower if they invest in a VC that loses money to inflation and returns 1.2x over 14 years, or it's a 10x. They just don't want to get fired for going with an unproven fund. They're putting it all into Andreessen. So at any rate, we make VC LP investments as the fund of funds into those VC funds. And we say, we're going to invest in your final close right before you start raising money for the next fund. So they basically are raising money continuously for 24 or 36 months. And they go, hey, enough's enough. We got to stop this fund 1 and start raising fund 2. Or we got to close fund 2 and start raising fund 3. We come in at the final moment and say, show me how many companies you've invested in over these 24, 36 months, and how many of them have raised money at a higher valuation, and how many have gone to zero, and how many are kind of struggling. So if they've invested in 15 companies, I'm like, all right, Edward, show me the superlative VC portfolio of your fund 3 or your fund 4 or whatever fund you're on.
Yeah.
And I can say, do I want to be in this fund? Yes or no. If
by looking for performance.
That's right. So So let's have fun with this. If the superlative VC is funded a company at a $10 million valuation, and now they've raised money at a $100 million valuation because this AI stuff is working, let's just kind of avoid some math and say you're at 10x up, and then 3 of your investments have gone to zero. So if you did 1 million check into 15 companies, 3 of them went to zero, so you're down 3 million, but a bunch of them have raised at 2x, 5x, 3.8x. And one of them has actually raised money at a 600 million, and you were in at 5. And so that one company is paying the whole fund back. And then I say, I'm going to give you a check for 20%. You only raised 8 million. Here's a check for 2 million. You need that 2 million for the management fee to pay your employees, pay your tax, fund admin, travel, whatever. You're not going to say no. And on the day that I put in the 2 million, I want to see a financial statement that says my 2 million has a fair market value of 4 million. So we basically only invest in the VC fund when we're doubling our money. If the fund is at 1.5x, so my 2 million is worth 3 million, and I go through the portfolio and I can see, after all these years, I'm qualified to say, is this thing fundable or not?
Yeah.
And if it's growing revenue and we can see how it could tip into profitability and blah, 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 competition and everything, I'm like, all right, Superlative VC might be at 1.5x, but it's going to be at 4x in under a year because this guy hasn't raised money and he's profitable. He grew revenue by 50x. They just didn't want to take the money.
Is shorter, but there's revenue. That's okay.
Like I know I'm going to make a 10x on investing in your fund, even though you're at 1.5 now, right? So by going through the process of looking at all 15 companies of 200 VCs a year, I'm cherry picking which ones my direct fund wants to invest. So you're telling me, oh, this company I invested at a $20 million valuation and they're profitable and they grew revenue by 20x. So I invested when they had 1 million. Now they have 40 million of revenue and we're going to raise money at this one. I'm like, all right, you introduce the CEO because I have a direct fund and I want to invest into the primary next funding round of that company. And also, how much money have you returned to your LPs now that you're about to raise your next fund? And you're like, well, it's only been 36 months. That's not enough time for an IPO or M&A. So we've returned zero money. And I'm like, all right, dude, Edward, if I can buy 10% of the shares you own in your top 5 deals on the secondary market, so you sell me those shares and we'll figure out some valuation. Maybe it's at a discount to the last round, maybe it's flat, or maybe it's a premium. Because if you invest, well, it did well. If you know the next round is going to be $1 billion, you're not going to sell to me for 500 million, but you might at 700. Or I might even say, he's just not selling to me. If the last round was 500 million and the next round is $1 billion, I'm going to buy shares from you at 700. So you can mark up the 90% that you didn't sell and you can receive cash and return the whole damn fund. So what often happens is the fund of funds is the goose that's laying the golden egg. We find deals for us to fund very efficiently. So without this shell game, I'm like, what's your revenue? And he's like, I'm not telling. I'm like, Edward, what's the guy's revenue? You're the VC. You should know. I've got no patience for this. So by the time I talk to the founder, I know everything about them. From VC, the guy. Yeah.
The VC fund, it sounds like, are in a sense, like if you're using an art term here, like they're the curators that you work with. And it's so interesting that the model is you look at the performance of their portfolios at a high level. That's how you can work efficiently. You don't need to deep dive so much into the companies. That's
actually no. We deep dive on every company before we'll invest in your fund. So it takes me more work to invest in a fund than it does to invest in a startup. Startup is just one company to diligence. I'm diligencing every single company in the fund before I put money into it. You might show me, the fund is at 5x, and I look under the hood at this, and I'm like, this thing's got AIDS and Ebola. I want nothing to do with it.
Yeah.
So the fund of funds gives us deal flow to invest in when the company's raising money, and then I can do a strip sleeve of invest in your fund, and a day later buy shares in 8 of your companies where you're selling to my direct fund 10% to 50% of your position, depending on where you're at. You might even sell 100% of your position. You're on fund 5 and you're still in this thing after you're in year 13. You just got to put a bullet in that fund and get out of it. So we might buy you out. And so we've got very good cherry pick access to the outliers that come from the VC fund, the VCs that we do invest in, and even the ones that we don't. When I go through your whole portfolio and then say, well, now that I've given you feedback, you can see this entire vintage is bad. There's no way I'm investing in your fund. And they're like, hey, I'm learning a lot hearing you critique and give me feedback on all 20 companies that I'm in. And I'm going to do much better on fund 2. We all make mistakes on fund 1. So I want to keep this relationship going. So maybe you invest in my fund too when I give you final close arbitrage at the end. And then I say, but there's one company that I love in your portfolio. Can you introduce the CEO to me? And if they will, and even if they didn't, I'm not shy. I'm just going to knock on their door and say, I heard about you from Edward. We'd love to get behind what you're doing. I even had the same idea, but I love your company. And then they'll let us invest. So number one is direct investing, cherry picking. Number two is this FOF thing, where we basically double our money every time we make an investment, and we're hoping that it goes, doubles again and again from there. The third thing we do is invest in that pre-IPO Anthropic, OpenAI, Perplexity, Replit, these kind of rocket ship AI companies that are, changing the world, SpaceX, XAI type stuff. And for that, we typically are buying the shares from a VC that's already on the cap table. And there's we probably don't need to get technical unless you want to, but in order for a VC to sell shares in one of their portfolio companies to an outside buyer, you need to get the company to do a stock transfer agreement or approval. So you need an STA.
Okay. A VC sending to another VC, there has to be a permission essentially from the
exactly. Okay. And for a lot of companies, they're like, yeah, sure, whatever. Who's buying it? They're not ISIS or Al Qaeda. Oh, this guy looks cool. Fine with me. So you get the stock transfer agreement in most cases, and then we raise money from our LPs, and we say, who wants to invest in this one company? We're making a VC fund to make one investment. So you might have been in our pooled fund of funds, which has got almost quarterly payments. It's like very safe, and it wires back kind of 2 to 3x whatever you're putting into it. Yeah. Then there's the VC fund that's very concentrated that could do even better, but it takes forever. And then you've got this thing that say, I think it's going to IPO in like a few months or a year, maybe 2 years. Do you want to be in that one deal? And so they wire money to us. We buy the shares, and then we could sell those shares on the secondary market if we wanted to, probably. And, or you wait for the IPO, and I distribute the shares to my LPs. And so if we did pre-IPO Google and we sold after the lockup and wired the money back, they would have missed the big opportunity. So we can just distribute the shares to our LPs, and they can hold that Google, Amazon as long as they want. And, they can borrow money against their stock and never pay tax, on it. The thing is, technically, the company has to give you a stock transfer approval, permission. Permission,
yes.
And in things like Anthropic and OpenAI, the answer is always no. And so they're just not going to do that. Because if they did, they would have so many shareholders that they would violate SEC, laws and statutes, and they actually have to go file an S1. And they don't want to do that right now. They want to control when they go public. And in some cases, they don't want to go public. So you often get blocked on the transfer of the shares. And even if you get the STA, you would never try to do that on Anthropic or OpenAI because
you'd undermine them.
No. Even if they said, we like you so much, like, oh, you're the biggest man in Japan, I want you on the cap table. The problem is all the guys like me that were the real VCs that invested in it, we have preferred rights and privileges because we bought preferred shares. And a key one is the ROFR. So ROFR stands for right of first refusal. Anytime the founder or the management team or the employee ESOP, employee stock option pool, or a VC that's on the cap table, anytime they sell their shares, I have a right of first refusal to buy it, and I have 30 days to exercise my ROFR, or waive it. So even if buyer and seller agree on the price to buy this Anthropic because we got the permission, I'm going to ROFR everybody. I would ROFR. I would ROFR anybody on Anthropic and OpenAI, and I would give it to my network and say, hey, someone's trying to sell 50 million of this. Go get me 50 million and I'll pay you a percentage. So we're going to ROFR everybody. So you end up with these like forward contracts where you say, okay, I'm not even going to ask the company for permission. I'm not going to put myself in ROFR purgatory or get
Yeah.
ROFR'd.
Yeah.
I'm going to sign an agreement that says after the IPO, when all the preferred shares convert into common, into one class, and so all ROFR disappears and evaporates and it's gone.
Yeah. Then.
And after I survive my lockup of 6 months, is what we expect. At that point, when I'm unencumbered to transfer the shares, I'll transfer the shares to you. But let's make this deal now.
Send the money over, and I promise to give it to you.
Send the money now.
Yeah.
Send the money now so I can wire my whole fund back on this, centicorn, whatever, gazillionicorn.
Yeah.
And because I need the money now to pay my LPs back, like that would make them happy. And I'm not even going to tell Sam Altman this is going down.
Yeah.
And how can they stop us from wiring you money after the IPO and I'm unencumbered? And if it goes M&A, whether it's like all cash or cash and stock or cash and borrowed and interest rates and all kinds of weird stuff, whenever I get that exit consideration on these shares, I wire to you and nobody can stop us. Now, these companies don't like that. They have terms in their shareholder agreements that the VCs invested in that you're not allowed to enter into a forward contract. You're not allowed to encumber your shares in any way. So technically, the founder, the VC, whoever's on the cap table, is not supposed to be entering into a forward contract of any kind. That's circumventing transfer permissions and ROFRs.
Yeah,
but it's very hard to stop it from happening.
Yeah, because
companies
it could happen between anonymous people, right? Like you could go in the darknet, or you can have it all in private messages. You can't.
I mean, you don't need to go into some Jepstein Island to do it. I mean, it's just like meet me on University Avenue in Palo Alto for lunch,
of course. Yeah.
We'll either do it or we won't do it.
Yeah. So, Andrew, I have to say, like, we've covered a lot, right? And I really value you're really sharing like how the mechanics work, and I'm like I'm pretty astounded. I'm learning a lot from you, and the thing is, I'd love to have you on the podcast again another time. Maybe Anthropic would already be IPO or public, or there's another huge round internally. We could talk about it then. But yeah, like I just want to leave a final question, right? Like the capital markets changing, right? But yet there's still new technologies coming down the line. You think this playbook will, with how the future is going to turn out, this playbook of how capital is changing, is it going to be accelerated? Is it going to be? Do you think it could be something in the works that's coming up, a new model that's coming up, and be replaced by that? What's your view of?
Yeah, I think the outlook is just positive, especially in the United States, and that we're going to see increased levels of liquidity, where you don't have to wait for an IPO, you don't have to wait for M&A. You can basically sell your shares. So those boys in Houston that were saying no to all my VC funds should listen to this, session and wise up and learn something and give us the money, because they're more liquid now than ever before. And that is a good thing for them and for a lot of people. I think that there's more money for pre-seed than ever before. There's more accelerators located, not just it used to be Silicon Valley and Boston, then New York kind of came, then New York fell off a cliff, and then they came back with a vengeance. And then Austin has always been there. It's basically post-COVID, the innovation could be anywhere. So I think that we're very unshackled from roadblocks that used to prevent us from making progress. So I think there's money at every level. There's more funds that just do this topic of cyber or whatever, or healthcare, or nutrition, or food. So I think it's a very exciting time to be a founder. I think it's a very exciting time to be a VC. I think it's a very exciting time to invest in a startup. And if publicly traded equities is your thing, you should probably buy shares in Anthropic and OpenAI and Perplexity, and just put it away like Bitcoin and look at it in 20 years, because I'm sure it'll do well. I believe that the shares we have in Anthropic are going to possibly go up 50x depending on your time frame. And so it's actually life changing for me. I've always been excited about the early stage, and I've always almost looked down on people that just come in on late stage and like, you're just doing an AUM game of collecting the management fee. Like if you and I raise $1 billion, we pay ourselves a 2% management fee every year. That is a zero risk 200 million. Like even if we mess everything up, we walk away with 100 million each roughly. And if their fund is 6.8 billion every 2 years, it's just an AUM game. I used to look at that and be like, you guys are not even real men. Like, what is that?
You're not building
whereas now that I'm doing these SPVs in the late stage, I feel like our whole life of those VCs I was raising from in the 90s that are now running the show, I've got direct access to them to be able to get stock transfer agreements done, or they agree, they own the shares, and after they're unencumbered, they'll make the distribution without getting ROFR'd and stuff.
Yeah.
And I have what I call zero counterparty risk. So I think that the level of liquidity for the founder, for the seed investor, for the LP, for the Series B, the Series C, the Series D, and even the mega funds have liquidity from crossover and guys like me. It's a really good time to be alive right now. And I don't think it's going to be a one pony take all. I think that there's, one thing that's interesting about Sam Altman is that he took over from Paul Graham running Y Combinator. And so he has this experience of looking at thousands of companies applying to get into the cohort and moving thousands through. And so he's learning from just what happened. So he's got, learn from the facts and your own experience. And so I think OpenAI could potentially become like a Y Combinator itself that is launching companies like they made the Apple iPhone and now they're going to fund the apps that run on the iPhone kind of thing. So I think
the AI apps,
it's a very different DNA from Anthropic, good or bad. So I think it's incredibly exciting to see what's going to happen.
Oh man, yeah. And yes, capital formation is different. Yeah, there's a lack of, there's no want for capital. But one thing I'm taking away is it's made it easier and more exciting to be a founder. So it's very heartening to hear that. So yeah.
Okay, Edward, thanks so much for having me on.
Yeah, I want to leave it at that. I'm gonna end the stream, but I just want to say a few words, if you don't mind, just giving me 2 minutes.
Sure.
Yeah. So yeah, ladies and gentlemen, thank you so much for joining us. This has been an amazing podcast. Bookmark this.